Hey guys, welcome. I just wanted to drop a quick video here. We've got this really weird market, right? So weird market, VIX between 20 and 23 for the last little while, and really not coming off today, even with that CPI number out. Now, I've been warning, if you guys have been reading my newsletters, you've been reading my comments on Twitter, I have been saying for months that the concern is not growth in this market, in the economy. The economy is fantastic. All the data points to things being just fine. The concern at some point, and I said this, the concern could be inflation. What do we have? A stronger than expected CPI this morning. It is adding to some of the uncertainty, right? And rate uncertainty is where we're really starting to see it, right? Look at the MOVE index. That is the bond volatility index. Look at it zooming from very recently up to almost yearly highs. We're going all the way back, in fact, all the way to December of last year. So highs for the year. This is yet one more piece of this inflated concern that we're seeing out there. The VIX futures, the VIX futures curve that really looks very concerning. We're really fully backwardated here. Look at where the VIX cash is, which is the green line. You can check this out at vixcentral.com. And we've got the VIX futures curve below VIX cash fully. We've got those front futures very concerned. October is going to be expiring soon, but we still have this really very concerning look to the VIX futures curve. This is not a sign of health, not a sign of happiness in terms of equity markets. Yet we have equity markets kind of marching up day after day. And so we've got this sort of weird world where you're making money on stocks, you're actually making money on hedges a lot of the time, and times are good, as Oprah says here. So very, very strange market. It's in fact, in my newsletter today, I mentioned it's one of the strangest climbing the wall of worry markets I've ever seen, where stocks are saying things are fantastic, we're priced for growth, we're priced for everything being great, and yet rates, up until maybe very recently, it's saying we're priced for recession. The MOVE index now reflecting the fact that we have no idea what rates are going to do. Some people, UBS came out, they said, no, we're going to still see 200 basis points of rate cuts. The problem with that is if rates are priced for recession, but everything's pretty good overall in the economy, stocks are priced for growth, well, you're going to have the former, which is juiced rates, low rates, juicing the other, which is stocks and companies in the economy. So one is going to really influence the other. If you get rates down too much, you're going to start seeing some of this inflation. We saw that the dock workers are going to make a whole bunch more money. Shipping rates are going up. We saw CPI this morning. We're starting to see some signs of inflation from used cars, etc. So things are not all well on the inflation front, and this is really what I was warning about for the last couple of months. As everybody was talking about recession and growth, you guys know very well that I've been making relentless fun of people saying the economy is slowing down, because it's just not happening. And that whole 50 basis point cut from Powell was, look, real rates are too high, I guess. So you can make the case that you need to get them down a little bit. But there's nothing tight in this economy. Things are going just fine. So now, let's be realistic here. To me, it feels like we're gonna get a big move. Things are way quiet, and there are a lot of signs of worry out there below the surface. You can think of it that way. Stocks are saying everything's okay, but a lot of risk measures. We just saw TLT come off really, really hard lately. That's probably part of what's going on in the MOVE index. But what does that mean? Are people selling treasuries around the world? Where is this supply coming from? It's that MOVE index is pointing to something untoward happening. So what can make that worse? Well, if we look at CTA positioning, we're massively long on the CTA side. That means a lot of books are very long stocks, 81st percentile. And the problem with that is we are generally net sellers. So even in a flat tape, I know this is kind of getting into the weeds a little bit, but in a flat tape, just think of it as there's stock for sale. In an up tape, there's going to be more stock for sale. And then over the next week, we're going to see a lot of stock for sale potentially from CTAs. And if you get the market down, that's what this is saying, down 1 standard deviation, down 2 standard deviations, you're going to get this cascading waterfall of potential selling. So this is the world that we live in now, right? And I told you on the LaDuc show, it is vol clustering. Either we stay high or we stay very, very low. in the volatility world. And we're bouncing back from those extremes faster than ever. Early August, bounced all the way back, came off again. So we're seeing very extremes. Right now, we have this low volatility in reality, right? The market's not really doing anything. We're trading at like an 8 or 9% realized volatility. That's very, very low. It has gotten lower, but there's nothing doing. The problem is if you start to get markets down beyond a certain point, that could cause a lot of cascading. It's going to come from CTAs. It's going to come from vol targeting type structures. It's going to come from synthetic short gamma from a lot of these products that have been created, levered products, inverse products, things like that that start to need to sell into sell-offs, right? That's the accelerant. You need a spark. You need something that gets us down to the 5,600, below 5,600, let's say, for argument's sake. But once you get that something, you can get the accelerant where the house really, really starts to burn. And so that's really a very big risk. So basically, every 1% sell-off, we buy it. And we've seen that happening in markets. This is the new reality of the vol clustering world. We buy every 1% sell-off, we buy every 1.5% sell-off, but a 4% sell-off could turn into a 10% sell-off. So we can see some of the gamma positioning here. So here we can see the gamma profile. Now keep in mind, these things can change. These are in flux all the time. These positions are not just staying static throughout periods of time. They can change, but generally speaking, we can see that as we get below 5,600, we get into this negative gamma territory, which is a bit of what I've been talking about, related to what I've been talking about, CTAs, etc. Above, we have positive gamma, so we're going to probably not get up too high. We're probably not going to sell off too much, but again, you start getting down maybe you get a little bit serious sell-off, and that could start snowballing a little bit. And we can see another sign of worry. Look at the signs of worry here. The U.S. election, the worry level surrounding that event, right? So we're looking at premia assigned to major market events of the past year. It's incredibly high right now. Let me flip that on its side so we can see some of these events. A lot of them are in 2024. We do have a couple here. Last November, NFP was big, FOMC was big. Remember, we've had this massive worry over the recent FOMC in September, the CPI number in September, July FOMC. So there's a big worry, but look at this election here. Very concerned market. This is meaningful. Because to me, it's not just about the election. Something else is seeping into these worry measures. I feel that in my heart that there's something very concerning. Now, in the meantime, so I'm talking about in my community, I'm talking about owning VIX butterflies. I'm buying some upside structures that I think are going to come in really handy if things get a little bit ugly. So I think you have protection, but at the same time, you have a lot of juicy downside skew that you can take advantage of. NVIDIA, this is one example, and I call this the looking left, looking right sort of situation, right? Calls are getting crushed. Nobody thinks a lot of stocks can keep going up, so that makes the upside cheap. It makes it look interesting. So when everyone's looking left at the left tail, take a peek to the right tail. So that's kind of this sort of scenario here of normally you have very flat skew in NVIDIA. Right now you have very lopsided skew. The puts are expensive. The calls are not expensive. And so you can put on some really cool structures right now, selling some put spreads to buy upside call spreads, or just selling some puts at a level that you like. Now, how do people pick these strikes? Well, you can pick a strike based on a level that you like on the chart. Maybe it's 110, maybe it's 105, 115, whatever that might be. You might pick a strike that associates with some sort of fundamental metric. Maybe you think NVIDIA's PE is cheap at a certain level at 110, 105. That might be another way to pick a strike. So you can kind of sell that downside and say, well, I'm happy to own NVIDIA at that level, but in the meantime, let me use volatility skew, right? This is trying to be the casino. You're using edge that the market is giving you. It's saying, look, sell this expensive skew, buy some cheap upside skew, and you're actually using volatility to your advantage in that case. Here's some in December, so kind of a cool trade here. similar, but you can see the skew is really a smirk at this point. We often call this a smile when it goes up to the upside. Right now, it's very typical to index skew, which is very steep to the downside, which makes things kind of cool because when markets are hitting highs, you often skew. Why? Because people are staying long, they're a bit nervous, they want to stay long with protection, mostly. Maybe they're buying, they're getting bearish, but a lot of the time it's, hey, I need to buy protection and I'm going to stay long. That's the way a lot of the street works. And so they push up that skew, and that's interesting for us because we can play that downside skew, which is a really kind of neat thing to be able to do at market highs when you maybe don't want to go all in on stocks. You can kind of some money puts out of the money put spreads and kind of collect that theta. If you add some downside protection, as we like to do in the community, have some VIX trades, have some, maybe right now we don't have any downside S&P put trades, but you can consider things like that. That makes this situation kind of cool as well. So some of the other trades we've been doing in the community, we've been, as I said, we're looking to harvest that expensive theta, that elevated theta. We've been covering puts in Amazon. We covered today, yesterday in Salesforce. We like to have it spread out across different. Don't do everything in semiconductors. Don't do everything in technology, for example. Have your bets spread out a little bit so that you're a little bit more diversified. You look at something like McDonald's or Home Depot, been doing fantastic regardless of the market that we're in. So make sure you're looking to places like that, even if you're getting a little bit less premium than you would on a Bitcoin or on Nvidia. Make sure you're spread out a little bit on the basket of your trades that you have on. Don't be in one. So we've been sort of covering things. We had Eli Lilly puts that were a really nice win. Those got threatened a little bit to the downside, but it came right back again, even though Novo Nordisk has been doing poorly. And we did really well on those puts. So lots of cool things to do out there, even though risk levels are high. So I want you guys to really look around, understand that this is a very touchy situation, even though markets are at all-time highs, but there are still many cool things that you can do. Next video, I'm going to talk about my cool put ratio spread on MSTR and a couple other trades that I've been looking at. I hope you've enjoyed this, and we'll see you next time.